Well, 2011 is over. Sorry, guys, it's done. And the S&P was flat on the year. That means there is only one thing we can do at that point, or at this point, and that is look forward to 2012. Let's pull out the crystal ball. And when you're talking crystal balls, there's one guy we like to go to for help with that. He is Linn Ellis, the Chief Investment Officer at Strategic Financial Group. And Linn, thanks for joining us. I know you got 4 topics: emerging markets, commodities, the Fed, and what you're calling an October surprise. Talk to me first about the emerging markets. Why do you think we're going to have both a debt and an equity rally?
Well, you know, it's interesting, Adam, that given the return structure, and just to build on what Matt was talking about third year of election cycles, one of the things Americans don't like to do is to tie. They don't like soccer very much. And this is only the 4th time since 1926 that we've ended within 1%, plus or minus on the S&P. That stands in stark contrast to the emerging economies. Large, broad indexes down to anywhere between 16 and 20% in both debt and equity. And when one looks at them, both in the terms of relative to their currencies and the strength of the U.S. dollar, our thoughts here are that you could see the reemergence of further U.S.-based multinational investment in these places. And that the emerging economies themselves are a little bit less emerging, and that the intramural trading boosts or puts a floor under those economies, and therefore, they themselves are less dependent on the developed economies' export-driven demand, and more, building a sustainable intramural economy.
Well, let me ask you, though, Lincoln, the emerging markets ETF, EEM, a lot of guys like to trade that. At one point, it was Harvard's largest position. That thing is down 19% this year. I mean, is the case really strong enough that you get a rebound and try to make up that lost ground?
One would suggest, as Jack Bogle told us, 14 days ago, if one invests in equities or debt, really, for a 1-year time frame, one should probably not invest. This is an idea that is germinal in 2012, but really talks about a global healing scenario that plays out over the course of the next 3 to 5 years, where you do have the global rebalancing scenario play itself out in a less spectacular way than we've seen over the course of the last 18 months, and that you settle into a rhythm where, again, the emerging economies are a little bit less emerging, a little bit less export-driven, and you really begin to get that domestic demand economies growing up in those places. And that, in fact, would be good for both the core parts of Europe as well as the core parts of the U.S. export market.
Lincoln, tying together the theme of emerging economies that are becoming more established, as you're saying, and then the needs that they have, energy is just one of note. What is that going to mean for commodities in 2012?
You know, Deirdre, it was interesting to listen to the commodity conversation that you had earlier in the hour and really note that it is reflective, as you rightly point out, of the demand base that is so robust across the emerging economies. And when you couple that with the kind of distractions that we've seen out of Europe and an economy that, sort of was tilting back and forth between would we go into recession or not here at home, the demand both in the energy sector, which would be the large part of the manufacturing complex, and or in the discretionary space, where you have things like meat or agriculture affected in those equations, there will be a more substantial case to be made for both the energy side of the complex and the consumable side in terms of food as we get through the backside of 2012.
So, Lincoln, since you brought up food, give us a price for corn or cocoa. Where should some of these softer commodities trade?
Yes, cocoa, our favorite volatile trade from the Ivory Coast. It, too, had traded under 2,000 just the other day for the first time since 2009. Just like natural gas trading under $3. Look, natural gas around $2.50. Cocoa, again, under that 2,000 level. And corn really below $6, more around the $5.50 range, given the nature of its place in the feed part of the chain. Those are the price levels that we're looking at across the commodity complex.
Hey, I just want to take a moment here, Lincoln, and note on the screen, Deirdre and I were looking at this back and forth. If the S&P settles exactly where it did, 1257 spot 60, as they like to say on the trading floor, that is exactly unchanged on the year. And when we say unchanged, we mean very unchanged. Look at that, up, or I should say down 0.04%. We'll see where the final trades come in. But Lincoln, taking that to the next step, you know, it seems that stock traders have been looking to the Fed all year for help. In other words, QE1, QE2, if the Fed's going to throw money into this market, people want to be on the side of that. But you say, as you look out into 2012, that cozy relationship might shift and that people will be fighting the Fed. What do you mean by that?
Look, I think, and you've heard it echoed across a number of different folks over the last couple of days, and that is when you get a total return, both in the 10-year and in the 30-year bond, north of 30%, it is the expression not of value in the fixed income or treasury complex, but rather of fear about financial insecurity. Also, as you rightly guys pointed out, reflective in the financials here. And so what I think ends up happening is that people begin to rebel. Maybe Al Hunt's conversation with Ron Paul will be illuminating to this degree, where people actually ask the Fed to get out of the car altogether, not to step on the brake or push on the gas, but simply to leave altogether and to let the market actually begin to reprice itself, both in terms of where interest rates should be and to where value is across other parts of the asset spectrum. And so I think that you will begin to see people sell, particularly the longer ends of the yield curve. And I know that flies in the face of Operation Twist. But a 30% year-on-year return, barring Katie, the Eurozone collapsing, would be very, it just won't happen.
Lincoln, you mentioned Ron Paul. There's a lot of people, political strategists, who say, listen, if he stays in this race long enough, he's just going to make it easier for President Obama to win again. What does that have to do with the markets?
Look, the Republicans ostensibly did this in the 2008 time frame as well. They really couldn't quite make up their mind. There wasn't enough time to get momentum behind a candidate. And, Ron Paul distracting the other front runners or actually forcing particular issues of clarity on front runners may elicit some points of view from the Republican candidates that are less favorable than investors and or the American people might otherwise think. And that would pave a fairly wide swath for President Obama to find himself elected and potentially elected by quite a large margin. It's
so wait a minute,
note,
Lincoln, am I hearing you right? Is this your October surprise that Obama wins by a landslide?
The October surprise is that the U.S. has enough information to verify that Iran is indeed making nuclear weapons and that there is a preemptory strike from the U.S. On Iran. But if I can just say one thing about the potential Obama election is that the reason we're flat in this third year of the election cycle is that we borrowed gains that we would normally not have seen in the first and second year of the election cycle and pulled them forward as we rebounded out of the great contraction of 2008 and that 666 low of 2009. That will be a very powerful tool for the Obama administration as they go into this elections year.
All right, Lincoln Ellis, CIO, Chief Investment Officer at Strategic Financial Group. We appreciate your insights. Always kind of fun looking into your crystal ball. Thanks, Lincoln.
Deirdre, Adam, thanks.